Hello everybody. At this time we are talking about investment advice. Investment advice is any recommendation or guidance that attempts to educate, inform, or guide an investor regarding a particular investment product or series of products. Investment advice can be professional, that is, the investor pays a fee in exchange for the qualified professional's guidance and expertise, as seen with financial planners, or it can be amateur, as with specific internet blogs, chat rooms, or even conversations. And while it is usually legal to give stock advice or pass along investment information, it may not be permitted if you provide inside information. And then the difference between investing and speculating. On the surface, these two activities appear similar. Both involve spending money on a financial instrument with the aim of generating a return. Investing is about building long-term wealth growth in assets that also generate an income. On the other hand, speculation focuses on making a quick buck through buying and selling of assets. You could also urge that those who invest in assets that don't generate an income, such as in gold and paintings, are speculating. When you invest, you're usually looking to minimize the risk as much as possible. There's a delicate balancing act between risk and reward at play here. Your goal as an investor is to make a stable income from your assets over a long period. Speculators take on much more risk as a result of the required short-term return. They're looking for fast returns and they're willing to try riskier tactics to get them. Many even compare speculating to gambling. However, speculators do conduct research to make, in their opinions, the best possible choices. They also accept that they're taking huge risks because they want those massive short-term gains. And then, why is investment advice important? Investment advice is important because it helps individuals and organizations make informed decisions about how to manage their money and invest for the future. With the wide range of investment options available, it can be challenging to navigate the complexities of financial markets. Investment advice ensures that the chosen investment align with the client's goals, time horizon, and risk profile. Effective investment advice can also help mitigate potential losses, optimize returns, and ensure that the client's financial plan remains on track. For individuals with little expertise in finance, receiving professional advice can be a crucial step in building and maintaining wealth. And then, why take investment advice? Taking investment advice can be beneficial for several reasons. The first reason, Goal alignment. Personalized recommendation tailored to your financial goals, stage of life, affordability, risk tolerance, and investment timeline. And then second, peace of mind. Working with an advisor offers confidence in decisions. And third, increase potential returns and mitigate risks. Advisors help you navigate market volatility and help to manage risk by diversifying your investment. And then we move to practical applications of investment advice. Investment advice is integral to various aspects of personal finance and wealth management. It is commonly applied in the first retirement planning, helping individuals save and invest adequately for their post-working years. Second, education savings, advising on suitable investment vehicles for funding future educational expenses. Third, estate planning, structuring investments to facilitate wealth transfers. And fourth, wealth management, providing comprehensive financial guidance for high net worth individuals. And then investment advice as part of financial planning. Investment advice as part of broader financial planning takes into account various aspects of your financial situation and then not just specific investment goals. For example, you may want advice on how to allocate funds for long-term objectives like retirement planning and wealth preservation. This comprehensive approach ensures that your investment decisions are aligned with your overall financial strategy and risk tolerance. And then we move to investment styles. The first style, growth investing. Growth investing focuses on companies with above average growth potential, often in rapidly expanding industries. Investors in growth stocks anticipate higher returns through capital appreciation. And then second, socially responsible investing. Socially responsible investing emphasizes investments in companies that adhere to environmental, social, and governance criteria, promoting ethical and sustainable business practices. And then third, value investing. Value investing seeks undervalued companies with strong fundamentals, offering the potential for capital appreciation when the market recognizes the company's true value. And then fourth, active investing. Active investing involves selecting individual securities or funds with the goal of outperforming the market. This approach typically requires more research and monitoring than passive investing. And then fifth, income investing. Income investing aims to generate regular income through dividends or interest payments. This strategy often involves investing in dividends-paying stocks, bonds, or real estate investment trusts. And then sixth, passive investing. Passive investing involves tracking a market index or sector through index funds. This low-cost approach seeks to replicate market performance with minimal active management. I think it is enough. Thanks for watching.